Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review, this time for the week ending May 5th, 2023. So as you might have noticed, the title slide changed and the name in the charts also changed. Now it's not IA Investment Management, it's IA Global Asset Management or IA GAM now. So it's just to reflect the fact that now IA GAM has over $100 billion of assets under management. We're already well positioned among the biggest managers in Canada, and the term global asset management is largely commonly used in the industry, and it allows us to display that the scale and the size of our activities, and also to indicate that we have big ambitions for the future. So there's not any drastic change in the way we do things. We've been building towards this for multiple years, and now we want to reflect it through a new branding and through a new name. So just wanted to share that up front. It's the same thing, the same team as we had before, and we'll continue to build toward the future. So let's get back to business here. Look at this week's markets at the close on Thursday. As you can see, lots of red in equities this week, but as I'm recording this on Friday morning prior to market open, markets tend to be in a positive mood, so likely we will regain some of those losses. But on the bond market side, rates are higher, so maybe we'll turn to red. But interestingly, the oil price down about 11% on the week. That's a good bellwether of the view of the commodity market towards the economic activity that we can expect over the next 12 to 24 months. So a bit more downbeat here, and the price of gold up 3%. We have the Fed that is likely maybe done with hiking rates. Only the future will tell us, because now they're data dependent and the data remains strong for inflation and for employment. But gold gained at 3% in an environment of uncertainty post maybe last hike. This is a good environment to be long gold. Now, maybe looking at monetary policy, it's a table I've been meaning to bring here for a few weeks now. A few stylized facts about the lags in monetary policy, because we know monetary policy is a very important variable, very important determinant of economic activity and market activity, but it operates with a lag, and the lag is not constant through the different parts of the economy. So over the first 12 months, let's say, consumer credit is hit first when rates rise or when rates fall, because it affects the interest rate that people pay on their line of credit. If they have a variable mortgage, there's a direct impact there. So people feel richer or much less rich when there's tightening, and the impact of an individual move from the central bank takes between 0 and 12 months to be felt on consumer credit. After that, the housing market adapts to that, so between 6 to 18 months, typically the housing market is impacted, and now we're starting to see the impact of that. That's more evident in Canada and in the US. Housing prices are already down about 10%. Volume of transaction is down, all of that. So this is for each hike, and remember that we had a hike this week from the Fed, so this one will be reflected over the next 6 to 18 months in the future. So there's still a lot and lots of impacts that are ahead of us that will manifest themselves through the data as we move forward. Thus the uncertainty. Commercial loans then come after. Businesses put some projects on ice, so they invest less. And towards the end, well, inflation reacts to that, and then employment. Employment is the most lagging indicator of all. So that brings you to the 24 months window. So before we feel the full impact of rate hikes, it takes between 18 and 24 months. This is what the economic literature tells us. So since we just ended the tightening cycle in Canada in January, most likely ended because the door is still open for more hikes. In the US, if we just ended it in May, that means that we could feel the impacts of that all the way towards the end of 2024, early 2025. Thus, the uncertainty ahead of us, and thus, the careful stance in our portfolios. So I just wanted to share that and put it into a picture. Now, is the Fed done with rate hikes? That's the question. Mr. Powell did say that it's too soon to cut rates now, but they did open the door to a pause. It's just that they removed from the statement the sentence that said that they will be continuing to hike. So it's data dependence. Next meeting is live in June, but let's see how the data behaves. And the job report that we had this morning was very strong. More on that in a few minutes. Next week we'll have the CPI report, which is expected to accelerate on a monthly basis. So it's not a done deal that we have a pause, but maybe it's time to take a step back and let's say assess the impact of what was done. Mr. Powell also said that the banking system is sound and resilient. So we'll look into that in a second. But just before, is the Fed done with rate hikes? The market seems to think that it's done and it's about to start cutting. This is what we see in this chart here for all of the meetings coming ahead of us. The number of hikes expected, well, when it's negative, that means that cuts are expected. So this is not consistent with the message from the Fed. And if the Fed stays put and if they do what they say that they will do, well, this could bring some volatility again as markets have to reprice the new information. So this is how volatility typically happens in markets. And now looking at the banking sector, it's not a banking crisis. Remember that I mentioned that in the past, there are about 4,500 banks in the US, regional banks, and some are very specialized, very local, not well diversified. Some have, of course, not so good risk management. So when you have an impact of this size coming from a massive tightening of monetary policy, it's normal to expect that some banks will be facing some issues. And even if it's a very small percentage, that can still amount to multiple, dozens of banks having issues. And that leads to consolidation, just like we saw with First Republic Bank, which was not small by any measure. It was a very large regional bank. But this week we heard about PacWest being a target, Zion being a target. So some names that maybe you've never heard before in your life. But these failures here, they're leading to consolidation. And here, the table on the bottom left, nothing too scientific. I just got that off Wikipedia to give the source. But over history in the US, if you adjust for inflation, the top 5 failures, well, 3 of the top 5 were in the last 6 to 8 weeks. So that was First Republic, Signature Bank, and of course SVB, which started it all. So it's something that will likely continue over the coming months. Doesn't mean that the banking system is collapsing, but that should keep the markets on its toes. And on the right, you see that the market is still very prudent, because if you look at the relative performance of financials versus the S&P 500, well, we had a drawdown in March, and we are staying there. The market is not regaining confidence, and in fact, it's moving lower again. And there were some surveys this morning that came out in the US suggesting that about 50% of households and 50% of business owners are not quite confident about the stability of their regional banks. So there might be some more pressure like that. But again, out of 4,500 banks, if there's a small percentage that have some issues, which is manageable, which leads to consolidation, that still means that the news flow could be crowded by these kind of stories over the coming weeks and months. So we just have to anticipate that. Monetary policy tightening starting to be reflected now in the labor market. Yes, on the jobs opening side, so businesses that just post jobs on job websites or on their own websites, now this is starting to contract pretty quickly, but as you can see here, we're still very elevated compared to what is considered normal. So this is starting to bite there. But on the next slide here, job creation remains very strong. And in fact, year over year, the pace of jobs creation in Canada and the US is accelerating again, at least in the US. So we're seeing that, again, jobs are a lagging indicator. We're still seeing economic strength. And here that means that, no recession is imminent in this environment because the labor market remains strong, households are still spending. It's just that the accumulated impact at some point will lead us maybe to a tipping point, but until then, of course, it holds growth back, and it's a source of concern. So again, no need to panic here. Staying invested in the markets, that's the thing to do, but we have to be cognizant that there's a sequence here, and it's not an easy one to decipher, but it is at play right now. So what to watch next week? We'll have Bloomberg Nanos Confidence Survey. We'll have building permits in Canada. In the US, the NFIB Small Business Optimism Index should be a bit lower. CPI inflation, very important print next week. Month over month should be higher again, 2.4%, which is too hot for comfort. 5% year over year, stable, which is expected. So no drawdown next week. At least this is what the consensus is telling us. And the University of Michigan Sentiment Survey should be a bit lower again next week. So that wraps it up. ia.ca/economy is your go-to webpage. Everything you need you can find there. Next week, the review will be on pause, so I will be skipping next week. We'll be back in 2 weeks, so that means the next episode will be on May 19, 2023. So thanks for your trust, thanks for your business, and I'll see you again in 2 weeks.